Welcome to the Telltales podcast, where we discuss cash flow and its pivotal role in investing. I'm Mike Nicoletti.
And I'm Jason Wallace. Along with our co-host Hunt Lawrence, aka Mr. Cashflow, we're here to explore how cash flow drives the economy and investment performance.
And don't forget to join our email list at telltales.us to get the cash flow memo. It's about 20 pages covering 80 companies, the U.S. government's finances, and the energy sector.
It's like having a masterclass on investing in your inbox every week.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
All right, here comes Hunt.
I think we'll get through the energy stuff. I always say we'll get through the energy stuff pretty quickly because we got plenty of other things to cover. On Exhibit C, there's still this publicity, which I'm sure many of you have seen in the paper, between the IEA forecast for oil demand and the OPEC forecast for oil demand, and they're way apart. And they're talking about 24, which we're about halfway through. IEA says 800,000 barrels a day of oil demand increase. That'd be 101 down at the middle of the Exhibit C. So it'd be 102. We have 102.6. OPEC is saying 2 million barrels. So that would take it all the way over 103. I think it's a political situation, not statistical. I don't see how you could be that far off halfway through the year. Oil is rebounded. There was that OPEC Plus meeting where Saudi Arabia and the Emirates said they were going to start to produce some of their voluntary restrained oil in the fall because they thought the demand would be there. And then, of course, there's this dispute over demand. But when that announcement was like 2 weeks ago, it took the price of Brent down by $6 a barrel. WTI followed it, and that $6 a barrel has pretty much been recovered. So we'll see as we get further into the year who's going to be accurate there. On Exhibit B, it's remarkable. We produced 104 Bs a day in November, and current production is stuck at 100. So at some point, I have to redo this Exhibit B, but 103 estimate for 24 is going to happen if it's 100 up to date. One of the reasons I haven't changed it, or might not change it, is I think there's at least 2 Bs a day in the Marcellus that's been voluntarily shut in, and current gas prices are getting up. I mean, look down at the bottom. Last Thursday, the current month gas price was 305. At some point, I think we're going to see that gas in the market. The Marcellus is fantastic because you can shut in wells and you don't have any risk of any impact on your reserves. When you turn the wells back on, they come back, pretty much as before you shut them down. And that's unusual. That's the only gas field I'm aware of where you have that characteristic. And remember, if you look, there's 35 Bs a day of gas from Marcellus out of total supply of 102. So it's not that hard for participants in the industry to shut down 2 Bs a day. Exhibit A, this also needs to be updated. I'm hoping that 24 comes in more like this 1.5 trillion and not a much larger number. The student loan forgiveness gets accounted for as expense. I don't really see that it's expense, or certainly it's a non-cash charge. So I'm hoping that that deficit of 1.5 trillion is not too far off for 24. Like that, why don't we go to the front of the memo? I guess the first question for Mike and Jason and myself is, how in the world is NVIDIA, which is on page 3, at the time these numbers were done, NVIDIA had an equity value of 2.6 trillion. It's now over 3 trillion, and it's overtaken Apple and Amazon. Just look at that comparison. I mean, this is a run rate estimate, 110 billion of sales, 62 billion of free cash flow, which was a remarkably large free cash flow number. We go to page 1, and we cite across free cash flow. Apple's 95, Microsoft is 74, Apple has 385 billion of revenue. Microsoft has 264 billion of revenue. And you're this chip company, notoriously cyclical business with 110 billion of revenue and 60 billion of free cash flow is trading for more. Since I talk to Mike for 20 minutes every morning, when I direct this to Jason, what's going on here? Is Microsoft and Apple undervalued, or how do you explain NVIDIA trading for more in the last few days than Apple or Microsoft?
Yeah, I think it's more so that maybe NVIDIA is a little getting ahead of itself. The forecasts for continued growth are pretty aggressive. I think the high growth time occurred last year, and it's going to be hard for them to grow at the same pace. In order for them to do that, then the CapEx budgets on the companies on page one are going to have to grow, proportionally to that. So, are they going to be willing to spend 30% more every year on data centers? That's a hard sell, I think. Do you have a different opinion, Mike?
Yes and no. I mean, I think that NVIDIA is probably the most important company that there is right now. And they probably have the best position right now of any company, since this entire industry seems to be primarily dependent on their chips. The models that we've seen so far are trained on much older generations of their hardware. GPT-4 was trained on A100s, which are now quite old. We were talking about a chip that's 4 years old or more. We've had a new generation release, the H100s, and they announced, and I guess they begin shipping relatively soon, the next generation. So the technology is moving very quickly, and the benefits to moving to the latest chips are clearly there based on what we're seeing as far as new data centers being established. And the scale and size of these data centers is much bigger than anything we've ever experienced before. And Hunt's mentioned it in previous weeks about the amount of power that 100,000 GPU cluster will need to take down, and the importance of backup and all that sort of stuff. It's creating, an industry around it. So the question is, do these trickle down use cases actually create value? Because if the trickle down use cases don't create cash flow in some way, somewhere, then this is going to be a failed experiment. It's obviously creating lots of cash flow for NVIDIA today, but for that to be sustainable, we need to see that flow through. We're starting to see some of it at Microsoft, and I think the hyperscalers maybe aren't necessarily a great read-through because they're just selling it on to somebody else, and that business model seems to work very well so far. But for all the software companies that are incorporating this technology into their products, that's still having relatively slow uptake. I mean, you see OpenAI is doing a relatively good job of selling to the enterprise. Microsoft's doing an okay job of selling to the enterprise, but nothing in comparison to the amount that's being spent on training. So we are still very carefully watching what's happening in the market as far as where is the value from these products coming from. And part of that's going to be operational efficiency, be able to operate with fewer software developers, fewer white-collar workers. In a lot of cases, we'll be able to get a lot more done with the same number of people. And that's a pretty exciting proposition. Again, for that to translate into a sustainable set of cash flows for NVIDIA, we still need to see more proof in the pudding, I guess, if you will.
Hey, Jason or Mike, how much more than just chips can NVIDIA make revenue from? I mean, can they sell software or?
Definitely. They are selling software. They sell you access to models. They'll sell you kind of prepackaged models in a virtual server. So you can download essentially all the software to run a server, an AI hosted server. And you can install that on your own computers.
Yeah, I think the most recent quarter they did north of $1 billion in software, which maybe doesn't seem that impressive because the rest of the hardware sales have gone up so much, but it's represented a huge increase.
Right, and the software is their moat. We've talked about CUDA in the past, and Jensen says, and I expect it still holds true, but majority of their engineering staff is software rather than hardware.
Let's say there are a dozen large centers, like the one in Memphis, which has gotten the most publicity, which is people thought was Tesla, and then all of a sudden it's XAI, answer to OpenAI. And they're all 100,000 GPUs. So let's say that's 4 billion. A dozen times 4 billion is 48 billion. Those large centers put together by Microsoft, Amazon, Meta, et cetera, is that half the business? Or in other words, if I mean, the $4 billion worth of chips, presumably the rest of those centers are going to cost at least $2 billion. I mean, we see these capital budgets, but $6 billion is a lot of money. I mean, at some point, is it possible that everyone will have put their centers in, and NVIDIA sales will be 50 billion rather than 100 billion? Or how does that look to you?
Yeah, right now, I want to say the cloud providers are about half of the revenue. So if you include XDead and Tesla, that's going to push to the majority of the revenue. And the thinking is they'll have to keep reinvesting. There's a lifespan on these chips, and as you want to bring in more and more data to train the models, and you're constantly retraining models so they're current, you're going to continue to build out data centers with the latest chips. And the reason you might bring in more data, so we've talked about now that the language models have scraped pretty much all the text on the internet. The more data that you're bringing in is different modalities. So you're bringing in the images, audio, video that's on the internet, and now Tesla's bringing in video that's captured in the real world.
Yeah, exactly. I mean, I think the planning cycle for all these data centers is actually quite long. So NVIDIA knows relatively early on in the planning process how many they need to produce in order to meet the demand. We know of at least 15 that are of the 100,000 GPU scale. And then cost-wise, the H100s were about $40,000 each. The Blackwells are going to be quite a bit more expensive. So remember, that solution is a lot more, there's a lot more NVIDIA in that solution than there was in a simple H100 solution.
Yeah, and another consideration is we talk a lot about the training requirements. Once these AI algorithms become commonplace in all the software and maybe in all the cars that we're driving, things like that, the inference will be a huge consumer of this compute. So you're going to have to build out more of these data centers just to handle the inference and the live use of their algorithms versus the training side of it.
Well, Mike said it earlier. It's a unique situation in the industry that NVIDIA has. Go and look at page 3. There's no real competition.
Certainly not. People point to AMD, and I think they expect to do $4 billion in sales with AI chips this year, and NVIDIA is doing $26 billion a quarter, or last quarter.
Yeah.
Right. The thing to think about with NVIDIA is what are the constraints on the top end? Obviously, if hyperscalers can't rent out the GPUs to people profitably, then that's a problem. But in the short term, we know that's not the case because you see Oracle, for example, investing in a data center and then having 50% of the capacity pre-reserved with Microsoft.
And there's probably room to give. The payback period's less than a year, so they could, the cloud providers could lower the cost to drive more demand and still make money on them.
Right.
Yeah. What about other news in tech this week. The one that I want to raise that is Snowflake being hacked is obviously embarrassing, but how much do you think that hurts them with their customers?
Yeah, it's an interesting story because what is public about it that we've been able to get to the bottom of is that user accounts created by Snowflake's customers were hacked. And specifically accounts that were not protected with two-factor authentication.
Yeah, the last I read was the hackers behind the Snowflake breach weren't the ones themselves that got the passwords. So they ended up buying a list of passwords from another hacking group and found the ones that matched Snowflake customers because they specifically wanted to go after Snowflake data to pull out. So then they had a list of 165, essentially Snowflake accounts that they were able to access out of the thousands that exist. And then that's the ones they breached.
And it makes sense that they all happen so fast because in that event, I assume that when you buy passwords from another hacker group, they're also selling it to somebody else. So then you're in a fight against time to capitalize on your situation.
Absolutely, yeah. And then the danger there is they might not have actually grabbed Snowflake passwords specifically, but people reuse passwords so often, the chances of you getting, say, a Google password and it happens to work at Snowflake are pretty good.
Right. What about the news on AMD in terms of their being hacked? Different situation, I guess, or is that, again, an AMD customer, or how does that impact AMD's commercial relations with their customers?
Somebody claimed that their data was stolen from AMD and AMD is investigating it. Unfortunately, the reality of cybercrime is that everybody's potentially a victim. And in most cases, your threats may already be there. And it may have already been inside your systems for a long time before they become exposed. So it's not terribly surprising. And my view previously on cybersecurity companies is that cybersecurity companies would only last as long as their customers could depend on them, and they could only depend on them as long as they didn't have any major events. And it seems like the industry maybe has restructured that business model a little better in the last few years, because it doesn't seem that that's been as much of an issue. The reality is you you need to be running zero trust systems, and but unfortunately, individual users can become compromised if you're not using two-factor authentication, or some sort of malware can get onto computers and computer systems. There's so many ways for hackers to get in, and it's Jason says this all the time. It's everything is hackable. It just depends on how much time and money you're willing to put into it.
How much someone cares.
Right.
Yeah.
Okay, let's take a quick break for a message from Oakcliff Sailing.
Hi, my name's Aiden. I'm from Bermuda. I'm a grinder on OC86. We're getting ready for the Bermuda race, and I'm currently doing some work on this pedestal. I've been sailing with Oakcliff for about 2 years now, and I'm loving every minute of it. My name's Dick. I'm from Fisher's Island. I'm part of the Ask Grind team. Been sailing with Oakcliff for about 2 years as well. And I had some crazy experiences with these guys. It's a lot of fun.
And now, back to the show.
We promised last Wednesday we'd get on to sports and streaming. Page 4 is new, and Mike and Jason, I think, have been thinking the Netflix model was vulnerable. Put another way, in Berkshire speak, their moat wasn't that strong. But Jason, I've been talking to Mike, 20 minutes every morning, and Mike's impressed with the latest results. What's your view of Netflix at this point? Then we'll go on to Disney and Comcast and the others.
You hit the nail on the head. The switching costs are too low, and that's why I'd never been comfortable with them. That said, it seems like Netflix doesn't have quite the churn, quite the downturn in customers that the other streaming services have. So, it's hard to predict consumer behavior, right? Which streaming service wins, but it's starting to seem more and more like Netflix is one of the few that will last. And then my view on Netflix is it's just a cable company. It's a new way to deliver content. The cable companies had the classic innovator's dilemma where they didn't want to cannibalize their own business with a streaming platform. Netflix came in and did that, and they're essentially delivering you cable television. Between Netflix and YouTube TV, it's cable television just without a wired cable subscription. You get your internet however you get it, and then these guys deliver the content. So that said, I kind of feel like this follows the path of cable TV over the years, where right now we're paying for Netflix. There's a free tier with ads. We're paying for Netflix to get no ads. Eventually ads creep in there. And then eventually I think we're all paying Netflix to view the content with ads. So whoever wins, I think it'll be a great business.
But will it be as good a business as a cable business? I don't know that I've actually settled on that part yet, because cable was very hard to switch from. In a lot of cases, you couldn't switch from it.
That's true. Yeah.
I'm torn on it. My initial view was they were going to spend so much money on content, it would just eat up all the cash flow, and it would actually get harder over time to satisfy the population in order to keep them on the product.
The way I've started to rationalize the content spend is the cable companies they produced a lot of hardware. They had stores. They had huge customer service departments that fought with you if you wanted to cancel. So they had other expenses in other places.
Yeah, no, that's a good point. And here's an important thing about thinking about the next 10 years of media. This generative AI piece is going to change the whole video production process. We're likely going to see, like we did with YouTube, like more specialized niche type videos. It'll be easier to do production grade content, even relatively long format TV show or even movie length, for far less money. And does Netflix benefit from that? Absolutely. They own their content library, a high percentage of it. So their ability to utilize that stuff in the future is going to be big. And that's another thing from this past week that's been pretty wild are we've seen OpenAI's Sora, which is a model for generating like 10-second clips of video, but there's a number of other ones out now, including one out of China, which is really impressive and apparently available. So all of this stuff is moving quite quickly. And again, goes back to the story on NVIDIA and how important this hardware is, because each new generation of hardware is actually unlocking use cases that we didn't have before. So trying to size the market it's nearly impossible, because it'll take time for the use cases to materialize. But media is certainly a big part of that.
Mike and Jason, the NBA sports franchise came up, and I guess it looks like Walt Disney and Comcast are going to split it up, maybe a hit for Amazon. Do you see that as building up a proprietary position around those two organizations in terms of handling sports content, or it'll be hard to compete with them?
Yeah, I think so. That's still kind of the undecided market space. So no one's dominates streaming sports yet.
I think we're still in an experimental phase when it comes to live streaming. And you see Amazon doing both within one app, the Amazon Prime Video app, doing both live and pre-recorded, or whatever you want to call library content. YouTube and YouTube TV are doing kind of the opposite. They have one separate app that's all live and acts just like cable. So I think it's going to take some time to figure out the user experience, because there is a piece to this that is, well, hey, live is really just the same thing as cable. And Jason can attest to that, being a heavy user of YouTube TV. But I would guess that 5 years down the road, it all looks quite a bit different.
Do you think Netflix just sit out live sports?
I don't think Netflix wants to sit out live sports. They have a lot of sports-oriented, recorded, pre-recorded content, and I think they're going after the Christmas NFL games.
My theory on Netflix's foray into live sports is, and actually all content creation going forward, is everything is about mitigating churn. They have pretty granular data about their customers. You think about the, mitigating churn and generating new users. Doing the holiday games is clearly a play on, can I get the kids of a family to go home and visit their parents and have to log into their accounts on their TVs, on their parents' TVs, and then maybe the parents don't have it, they learn how to use it, and then Netflix hits them with the, oh, you have multiple accounts in multiple states, so you need to start paying for this, and they pick up new subscribers. And the other piece is, how do you mitigate churn? Well, you have to produce new relevant content that keeps people from canceling the app. So I think that's how they're thinking about sports.
Yeah, they did an experiment too with a tennis match between two of the top players. And it was kind of content that piggybacked off of their show that followed some of the tennis professionals through the season. So they're hosting their own sporting events as well.
Right. Good. Just quickly, any healthcare news? We'll spend more time on healthcare next Wednesday, but anything notable, Jason?
One thing notable is BioNTech had a clinical hold placed on one of their early stage trials. And the interesting thing, that's not abnormal, but it essentially means that the clinical trial has to be stopped until BioNTech and the FDA figure out what was going on. There are severe side effects to some of the patients. But the interesting thing to us is that it happened on a trial where they're testing an antibody drug conjugate. So this is outside of BioNTech's core competency with mRNA. So it's something Mike and I don't like, where they reached outside of their core competency to purchase an asset and now seeing it potentially fail. So it was some money maybe not well spent.
Yeah, you predicted that almost a couple of weeks ago.
Right.
So
Yeah.
getting out of their area of expertise. With that, everyone be well and stay healthy, and we'll be on next Wednesday. More time on healthcare next Wednesday. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.